an all-time high of $121.58 per ounce. It was a historic moment, 30 years in the making. The market had been grinding higher for weeks, driven by a combination of factors: strong industrial demand from the solar and electronics sectors, central bank gold buying that pulled silver along for the ride, and yes, some speculative enthusiasm that got ahead of itself. But what happened next was a lesson in market mechanics that every trader needs to understand. On Friday, January 30th, silver crashed. And when I say crashed, I mean a 30% intraday decline that wiped out weeks of gains in a matter of hours. The price fell from $121 to the low 80s before finding any footing. It wasn't manipulation. It wasn't a bank conspiracy. It was a classic liquidity cascade. When you have that much leveraged long positioning built up, when everyone is crowded into the same trade, it doesn't take much to trigger a stampede for the exits. Stop losses get hit, margin calls force liquidations, and the selling feeds on itself. Over the weekend, the narrative shifted. Social media was flooded with claims that this was a fake crash, that the banks had suppressed the price to shake out retail traders, that Monday would be the real move. I'm here to tell you that kind of thinking is dangerous. It's how you lose money. The crash was real. The losses were real. And anyone telling you otherwise is selling you a story, not analysis. So where did we actually close today? Silver finished the New York session around $79.27 to $80.02 per ounce, depending on which contract you're looking at. That's up about 1.6% from Friday's close, which is a decent recovery. But it's not the $83.14 that some people are claiming. It's not a breakout. It's not a fortress wall being defended. It's a market trying to find its footing after a traumatic week. Let's look at the volume and structure of today's trading. Silver opened in New York around $79.27, drifted lower through the morning session, touching around $78.50, then recovered through the afternoon to close near $80. Total volume was elevated compared to a typical Monday, but nowhere near the panic levels we saw on January 30th. The Commitment of Traders report, which came out Friday evening, showed that managed money had reduced their net long position significantly, meaning the speculative excess had already been washed out to some degree. Now here's what actually matters for Tuesday. The COMEX March silver options expire on February 17th, not tomorrow. There is no massive gamma squeeze scheduled for Tuesday morning. There is no turnaround Tuesday mechanical inevitability. What we have is a market that's technically oversold on a medium-term basis, fundamentally supported by industrial demand, but facing headwinds from a stronger dollar and rising real yields. The physical market is telling us something important. Premiums on American Silver Eagles and Canadian Maple Leafs have widened to $4 to $6 over spot, depending on your dealer. That's up from $2 to $3 in December, but it's not the $8 to $10 we saw during the 2020-2021 squeeze. The Shanghai Gold Exchange silver price is trading at a modest premium to London, around 20 to 30 cents, which indicates decent Asian demand, but nothing extraordinary. The London Bullion Market Association's daily price fix this morning was $79.15, essentially in line with New York. What about inventory? The COMEX registered silver inventory, the metal actually available for delivery against futures contracts, stands at approximately 82 million ounces as of Friday's report. That's down from around 103 million ounces in mid-January. So there has been a drain, but it's not the catastrophic 53 million ounce decline that some are claiming. The coverage ratio, meaning open interest divided by registered inventory, is around 4.2 to 1. That's elevated historically, but it's been higher before. In 2020, during the pandemic squeeze, we saw ratios above 6 to 1 without the exchange breaking. The real story here is that silver is caught between two competing narratives. On one side, you have the structural bulls pointing to decade-low mine supply, growing industrial demand from solar and EVs, and the long-term debasement of fiat currencies. On the other side, you have the technical reality that silver just had a parabolic move and a violent correction, that sentiment got way too hot, and that it takes time to rebuild a healthy base for the next leg higher. My assessment? Monday's price action was constructive, but not conclusive. we saw buying interest emerge below $79, which is a positive sign. We didn't see a retest of Friday's lows, which suggests some short-term bottoming. But we also didn't see any real conviction above $80. The market is waiting for something, either a catalyst to drive it back toward 85 to 90, or a failure of support that sends it back to test the 75-77 zone where it bounced on Friday. For Tuesday, the key levels to watch are $77.50 on the downside and $81.50 on the upside. A break below $77.50 would open the door to $75 and potentially $72. A break above $81.50 would suggest the recovery has legs toward $85. But I want to emphasize something. There is no magic to Tuesday. It's just another trading day. The banks aren't loading cannons. The algos aren't preparing a 3 a.m. liquidity sweep. Those are stories people tell to get views and sell subscriptions. The reality is more boring, but it's also more useful if you want to make money rather than lose it. Let me walk you through the actual mechanics of the silver market, because there's a lot of confusion about how COMEX settlement works, what the inventory numbers really mean, and why the paper versus physical narrative gets exaggerated. This matters because if you understand the plumbing, you won't panic when someone tweets that the COMEX is about to default. First, the T+1 settlement rule. Yes, it's real. When you trade a COMEX silver futures contract, the trade settles one business day later. If you sell a contract on Monday, you need to have the margin or the metal ready by Tuesday. But here's what the hype videos don't tell you. This is standard operating procedure. It happens every single day. The clearinghouses, CME Clearing for COMEX, have been managing this process for decades. They didn't just discover T+1 yesterday. The margin system works like this. When you open a futures position, you post initial margin, currently around $8,800 per contract for silver. As the price moves against you, you get variation margin calls. If you can't meet them, your position is liquidated. This happens automatically, thousands of times a day, across all markets. It's not a crisis, it's how the system is designed to function. Now about that open interest number. As of Friday, February 6th, COMEX March silver futures had open interest of about 137,000 contracts. That's 685 million ounces of paper silver, yes. But here's the crucial point that gets missed. Only a tiny fraction of those contracts will ever result in physical delivery. Historically, less than 5% of silver futures go to delivery. The rest are closed out before expiration or rolled to later months. So when you see 685 million ounces of paper versus 82 million ounces of physical, you're comparing apples to oranges. The paper market is a price discovery mechanism, not a physical delivery market. That said, the inventory situation does bear watching. The registered inventory, the metal specifically set aside and ready for delivery, has declined from about 103 million ounces in mid-January to 82 million ounces as of Friday. That's a 21 million ounce drop in about 3 weeks. Is that concerning? Yes, to a degree. Is it existential? No. Let's put it in context. COMEX registered inventory peaked around 400 million ounces in the early 1990s. It bottomed around 50 million ounces in 2016. It surged to 150 million during the pandemic. The current level of 82 million is low, but not unprecedented. More importantly, the eligible inventory, metal stored in COMEX warehouses but not currently available for delivery, stands at around 250 million ounces. If demand for delivery surges, dealers can move eligible to registered. It's a paperwork process that takes a day or two. The real constraint isn't warehouse inventory. It's the availability of wholesale 1,000-ounce bars for immediate delivery. That's where the market has tightened. The London Bullion Market Association, which handles the vast majority of wholesale silver trading, has seen increased demand from ETFs and sovereign buyers. This has created some friction in the physical supply chain, which shows up as higher premiums for retail products like coins and small bars. But again, this is a logistics and manufacturing bottleneck, not a fundamental shortage of silver in the world. What about the Shanghai Gold Exchange? The SGE is the primary physical precious metals exchange in China. Their silver contract trades at a premium or discount to London, depending on local supply and demand. Recently, that premium has been around 1 to 2%, which indicates decent Chinese demand, but nothing that would suggest a supply crisis. The SGE inventory data is published weekly and shows adequate stocks for normal market functioning. Now, let's talk about the March expiration specifically. The March COMEX silver contract expires on March 27th. But first, notice day, when holders of long positions must declare their intent to take delivery, is March 24th. Between now and then, we'll see open interest decline as speculators roll to May or July contracts. If open interest remains elevated into mid-March, that would be unusual and worth watching. But as of right now, there's no indication of a delivery squeeze developing. The coverage ratio, open interest divided by registered inventory, is currently around 4.2 to 1. I've seen people claim this means the market is about to break. But again, historical context matters. In April 2020, during the pandemic chaos, the coverage ratio hit 6 to 1. The market didn't break. In February 2021, during the Reddit silver squeeze attempt, it hit 5 to 1. The market didn't break. The exchange has mechanisms to handle stress, increased margin requirements, position limits, and if necessary, cash settlement rather than physical delivery for certain contracts. What would actually cause a problem? If we saw a sustained surge in delivery requests, say 20 to 30 million ounces per month for several consecutive months, while registered inventory continued to decline, that would create a genuine tightness. We'd see it first in the spread between futures prices and physical spot prices, then in rising lease rates for silver, then in exchange announcements about inventory management. None of those signals are flashing red right now. The other factor to watch is the relationship between gold and silver. The gold-silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, has been volatile. It hit 90 during the January silver crash, meaning it took 90 ounces of silver to buy 1 ounce of gold. That's historically high, suggesting silver was cheap relative to gold. It's since come down to around 85. A declining ratio typically indicates silver outperforming gold, which is what you'd expect in a precious metals bull market. So when you hear someone say the COMEX is going to default, or the paper market is about to collapse, ask them, what's the actual mechanism? How would that work, given the exchange's ability to cash settle, the eligible inventory buffer, and the normal functioning of the wholesale market? The answers usually reveal that the person making the claim doesn't understand the market structure they're talking about. So given everything we've covered, the actual price action, the real inventory situation, the mechanics of settlement, what should you do? I'm going to give you 3 frameworks, one for physical holders, one for paper traders, and one for people trying to understand whether this is the start of something bigger or just a blip. If you hold physical silver, coins, bars, whatever, my advice is simple. Do nothing. You're not a trader. You're an accumulator. The price at which you bought, whether it was $20 in 2019, $50 in 2024, or $80 last week, doesn't matter for your decision today. Physical silver is insurance, not a trading vehicle. It's protection against currency debasement, financial system instability, and the kind of geopolitical chaos that seems to arrive every few months now. The premium you paid over spot when you bought your Eagles or Maples, that's the cost of that insurance. It doesn't get wasted if spot drops. It doesn't get validated if spot rallies. You hold the metal until you need to convert it back to currency for some life expense, or until the monetary system changes in a way that makes silver more useful as a medium of exchange or store of value than the paper in your wallet. Trying to time the silver market with physical metal is how you end up selling low and buying high, paying premiums and taxes and shipping costs every time you flip. If you're a trader, futures, options, ETFs, mining stocks, then you need to be more tactical. The first rule is, don't believe the hype. The social media narrative around silver has become increasingly detached from reality. Every $2 move is either the start of a moonshot or the beginning of a crash, depending on who you follow. The truth is usually more boring. It's noise, not signal. For Tuesday specifically, watch the overnight session. Not because there's going to be a violent explosion at 3 a.m. London time, but because silver often sets its tone for the New York session during Asian and European trading. If London can hold above $79 and build toward 81, that sets up a constructive day. If it breaks below 78.50 and can't recover, we may retest Friday's lows. The economic calendar matters this week. We have CPI data on Wednesday, which will move both metals and the dollar. We have retail sales and industrial production data that could affect the industrial demand narrative for silver. And we have Fed officials speaking, which could shift rate expectations. Any of these could be the catalyst that breaks silver out of its $77 to $82 range. For position sizing, consider the volatility. Silver's 30-day realized volatility has spiked from around 25% to over 50% since the January crash. That means your position should be half the size it was a month ago if you want to maintain the same risk level. Leverage is especially dangerous here. A 3x ETF or a futures position with 10-to-1 leverage can wipe you out on a 10% move. And 10% moves are happening in silver every few days now. If you're looking at mining stocks, be selective. The majors, Pan American Silver, First Majestic, Wheaton Precious, have held up better than the explorers, as you'd expect. But even the best operators are seeing their costs rise. All-in sustaining costs for primary silver producers are now around $18 to $22 per ounce, which sounds like great margins at $80 silver. But remember that these companies hedge, that they have operational risks, and that their stocks often diverge from metal prices for months at a time. The longer-term picture for silver remains constructive in my view. Mine supply has peaked and is declining. Industrial demand from solar, EVs, and electronics is growing at 5 to 10% annually. Investment demand is volatile, but structurally supported by concerns about fiat currency stability. The gold-silver ratio, even after recent moves, suggests silver is cheap relative to gold by historical standards. But, and this is important, the path from here to there is never straight. Silver could trade back down to $70. It could chop sideways for 6 months while sentiment resets. It could rally to $100 and then crash back to $60. Anyone telling you they know which scenario will play out is lying to you or to themselves. What I can tell you is what to watch for. A sustained close above $85 would suggest the January high is in play again. A break below $75 would open up 68 to 70. The 77 to 78 zone is key support. That's where we bounced on Friday, and a failure there would be bearish. Volume patterns matter. Rallies on heavy volume that hold their gains are constructive. Rallies on light volume that fade by the close are suspect. Finally, a word about information diet. The precious metal space has become overrun with sensationalist content. Every price tick is a bank raid or a short squeeze. Every inventory report is a default warning. This stuff gets clicks, but it doesn't make you money. It makes you emotional, and emotional traders make bad decisions. Find sources that give you data, not drama, that explain mechanics, not conspiracies, that admit uncertainty rather than selling certainty. Your trading account will thank you. For tomorrow, set your levels, define your risk, and stick to your plan. Don't wake up at 3 a.m. expecting an explosion. Don't panic if you see a $1.50 drop in the pre-market. Watch the volume, watch the structure. And remember that the people making the most noise are usually the least informed. The silver market has been around for thousands of years. It will survive this week, whatever happens. The question is whether your account will.